All right, let's talk about top-down analysis. And this is my approach to the markets and always has been, is that the broader markets move the majority of stocks. There are stocks that are said to be on their own page, that'll outperform the markets, of course, and there's certainly a lot that will underperform the markets. But the top-down approach is one where we're saying, here are the broader markets, and they're going to influence the majority of stocks. So let's see the direction of the broader markets. Let's compare various markets to another, if they're in agreement or not. And then from there, let's take a look at where money is flowing into and out of various sectors. Some sectors will outperform, others will underperform. And then we can look at the stocks within those particular sectors to see which ones are the best performers or underperforming. And by taking this top-down approach, by the time we get to the individual stocks, we're going to be finding the ones within the markets that are the best, meaning they're in strong uptrends, they're outperforming, they're likely to continue to outperform. And that is the concept of relative strength, whereas a particular sector is outperforming the broader markets, and a particular stock within that sector is outperforming the sector, and that is where the money is flowing into primarily, and that should continue. And that's the assumption of the concept of relative strength, and the concept of relative weakness is just the opposite, and that what's weak should continue to be weak. And unless we're looking for short sales, right, we're going to avoid the ones that are showing relative weakness to that particular sector and the broader market. So let's take a look at the concept, which I believe is relatively simple but powerful. And this is, what I do every single day and week. So from a daily perspective, day to day, it takes a relatively short amount of time, and the software that I use to do that actually makes it extremely easy and fast to do. But as you start to drill down into the individual stocks, of course, it's takes time to get through that. But as you'll see, the software really does accelerate the whole process. Where years ago this had to be set up manually, which was extremely time consuming. So today things have gotten a lot easier, of course, through the internet and because of technology. But let's take a look. So what we're doing is taking a look, as I explained, at the broader markets and then sectors and then stocks, and we're taking a longer term view and an intermediate term view. So as we look at those broader markets, we review them, we take a snapshot, if you will, just taking a look, and you'll see how I set this up. Are those broader markets moving up, down, or sideways? Is the S&P moving up where maybe transports are sideways or moving down, or vice versa? And we can start to come to some conclusions just from that as to the health of the broader markets or the lack thereof, and where we might want to put our focus. Now we then look at sectors, individual sectors, and as you'll see from the scanning, we can review really quickly to see which ones are doing better than others. And then from there, we start to look at stocks within those particular sectors of interest, and we review them. And then we're going to look at our market internals, and I'm going to give you a really easy, quick way of monitoring or timing the market here that I've used for decades. It works really well. It's simple, it's easy, and you can set it up so easily and monitor it on a day-to-day basis and week-to-week basis at the glance of an eye in a few seconds. So let's go ahead and let's get going. So I look at the broader markets in this way, and if you're a advisory letter subscriber, you'll see this chart every single week, and I'll review this in multiple time frames, weekly, sometimes monthly at the end of the month, and of course the daily. And I'll look at the trend of these broader markets and which are outperforming the others, and I'll look at them on a bar-by-bar analysis. Are there failure patterns there which are confirming the trend, Are there breakout failures which create uncertainty? So everything that you've already learned, you would then apply to the broader markets, even if you're not trading them. However, you do have the opportunity, because these are ETFs, to where you would say, hey, here's an opportunity where the S&P 500 is pulling back to an area of major support, and the macro time frame is up, and bar by bar analysis says that this should continue in the direction of the prevailing trend. So I'm going to buy SPY, or it might be QQQ. Sometimes the Russell will outperform, sometimes it underperforms. But with the tools that you've already acquired in this course, you can come to really intelligent conclusions as to what is outperforming and underperforming, and whether you want to trade the broader markets or continue the analysis further down. So this is a minder that I created. It's easy to do, that you can create it. And this is platform, it's called TC2000. I don't have any affiliation with them, but I have been using it for an extremely long time. And I'll continue to explain why. But it's really easy to use, and creating some scans in it are relatively easy compared to what I would consider very difficult in something like TC2000 or eSignal or any other platform. This is about the easiest you're ever going to find to create scans. And as a student of Master Trader, I do provide these scans to you free of charge by emailing me through the platform if you have it. Okay. So this is one of my minders where I'm looking at the cash markets and seeing what is the percentage change on the day. What is it over the course of a week? What is it the course over the year? What is the net change? What is the weekly change? And what is the range? And that helps me come to some assessment as to what's happening in the broader markets. Of course, I'm going to look at the charts and compare, just as we did on the prior slide, but this is where I'm looking at a comparison of these broader market cash indices as to how they're performing in relation to each other. Now, as we start to move further down, I have a whole list of different ETFs. We're looking at those, and in this minder, it's just sorted by net percent change on the day. And you can set it up the same way as that prior minder of percent change on the week and on the year, and so on, to see where money is flowing into or out of on any given day, or on a week, or on a month if you choose, and of course on the year, to see how each of these sectors are doing. Now, this is the starting point, meaning just because something like biotechs are up at the top of the list on this particular day, that doesn't mean they're in an uptrend. They might be coming off of a bottom. They may be in a downtrend and just had a good day, which we're really not interested in that, because the trend is down. So as I said, this is a starting point to see where money is flowing into or out of on this particular day, and then we look at it on the week, and as already mentioned, we're looking at the particular charts and comparing relative strength and weakness and trends and support and resistance, and we're looking for what's had big moves. These next slides are examples of those ETFs that are related to that particular sector. So we look at financials and businesses that provide financial services, of course. And then there are different ETFs related to that. So XLF is a broader ETF where you have the bigger banks in there and brokerage firms, and XRE are the regional banks, and they can be vastly different from each other, even though they're both financial. But from that ETF, we can then move down and look at the individual stocks within it, and then do the same thing as to sort them by daily, weekly, look at the charts. That's the process. Technology, as explained there, and you could read, XLF is the ETF, and the platform mentioned, TC2000, breaks it all down for you. Meaning and you'll see that in one of the upcoming slides, when you set up the page that way, if you look at the XLK ETF, you can set up a minder that will populate all of the stocks that are in that ETF. And that's what you're seeing on this slide over to the right, where I've just captured some of those particular stocks, and there are more. And you can sort that by volume, by price, by percentage gain over time. So it's really powerful software, and the top-down approach is a powerful one, and where you could really begin to zero in on where the money is flowing into or out of, and then applying master trader technical strategies as to the appropriate entry points that put the odds in your favor. What more can you ask for? And so let's continue. All right, so consumer staples, businesses that are creating and selling products. I'm just saying Coca-Cola, Walmart, retailers, and Kroger, and so on. Campbell Soup. Now, sometimes these are so in favor, and it's interesting when they're not, that why aren't people buying what are considered staples? Why are you're buying soda and food and ketchup and soup and so on and so forth, and that at times is a pretty strong indication about consumer sentiment and the economy, or the lack thereof. Basic materials, chemicals, metals, and agricultural. So sometimes these do tremendously well, and sometimes they don't. Again, we're looking for where the money is flowing into and out of, so we can participate intelligently in that particular sector. There are going to be times when a sector will outperform or underperform, and we just approach it intelligently as explained to take advantage in either direction. Oil and gas going to be influenced by the price of crude oil, of course, and natural gas, and there are various ETFs for that. XOP and XES are focused more on oil and gas, while XLE is more about just oil, and OIH is about refiners. So we can zero in on these different ETF where there are like subsectors within those sectors, which they're going to primarily move together, but at times there are differences. And again, we can move down to the stocks within those particular sectors to take advantage of the ones that are outperformers or underperformers. If this particular sector is underperforming and we're looking for short sales to take advantage of that, we can short the ETF, or we could find the weakest stock that maybe is in a downtrend, and then it went sideways and it's formed topping tails and it's got a void below, and we're shorting that one. So we have a lot of different options as to what we want to focus on and trade either long or short. Industrials, businesses that are producing goods, using construction and manufacturing, and XLI is the ETF for that, and you can see the stocks within it. And some of these will do extremely well. So, for example, Boeing is actually part of another ETF called Aerospace and Defense, and that has done very well, whereas GE has done terribly. So these ETFs and the stocks within them provide a diversification by definition. Your job is to find the best of the best or the worst of the worst and take advantage of them with the tools that have been provided. Healthcare, you've got the various ETFs to take advantage of that. And this is a pretty diverse sector as well, where one sector, say pharmaceuticals, may not be doing as well as XHE. So you would obviously look at these and see, again, relative strength and relative weakness. Consumer discretionary, which means, hey, I've got the option to buy this or not. I don't need a new pair of sneakers, but if Nike's doing well, Well, maybe I want to buy Nike. This sector may be doing well, and Nike may be the best performer, where Ford and General Motors are doing terribly. But if I'm trading the ETF, again, I have that diversification of taking advantage of the good, not being affected so much by the bad. It's going to have an effect on the sector, but I'm not going to be as affected as someone that's buying a particular stock that's in a downtrend and out of favor. And I'm not going to do as well as the person that bought the stock that is in favor and doing tremendously well. But, we've got both sides, the good and the bad, and diversification is about not being exposed primarily to the bad. Telecommunications, utilities, you've got the idea at this point as to what we're looking at and why and how to take advantage of it. Internet, which is a huge part of the market today. The ETF is FDN. You can see the stocks within it. Snap, at the time of this recording, looks terrible, like you could possibly think it's going out of business, whereas PayPal is doing tremendously well right now, and those trends can change drastically over time. We all know of Amazon and, of course, Netflix, and exposure to all of them by buying the ETF gives you that diversification to be able to participate in them without the downside of a Snap, and to some extent right now a Twitter. Right? And retailing is obvious. Here is your retailers, and Amazon is in there as well as the internet. And so there are different stocks that are going to be in multiple ETFs, and we get to own those great stocks. And of course, we're getting exposure to the not so great ones. But again, that's the advantage of ETFs. But the top-down approach is one in which we get to choose what we want to do, right? What we want to participate in. I can participate in buying the broader markets and picking the best one. I can participate in a particular sector ETF by picking the best one and avoiding the worst one, and I can look at the stocks within it. So it's a great approach to the markets, and utilizing the software as I do makes it relatively easy. So the minder on the top right is the S&P Spider Sector ETFs, and they're listed there in that minder, and I can look at, as it shows you, percent change on the day, on the week, on the year, and I've created this minder so I can see if they're near a 52-week high, or is it making a 52-week high. So through different views of this minder, I can see what's strong and what's weak over time. I like to look at the cash broader market indices, as I've already shown you. Those are the ones that are primarily quoted in the media. So, and even just reporting as I do in the advisory letter, this is a help doing that. And then the broader market in these ETFs is already explained on the prior slides. And the great part about this platform is that if I click on FDN, that ETF, the minder on the left is going to populate with the stocks that are in it. And I've already explained to you, I can set this minder up with different percent changes over time and sort this minder and look at what's outperforming today or underperforming, or what has outperformed or underperformed that particular week. And on the year, I can sort it by volume. I'm not interested possibly on the low volume ones. And as you can see, the earnings reports are in that minder. So as I look at these, I can see that, hey, this is going to report earnings this week or tomorrow, or maybe it's in a few months, but I'm aware. And I can sort that minder by earnings dates. So during earnings season, by sorting that, well, now I automatically know what's reporting earnings tomorrow, next week, next month, and so on. So being aware of that is vitally important. So great platform that enables me to do a lot of work in a relatively short period of time and sift through, the markets, sectors, and stocks within it. Now, market internals, right? These are the market internals that I've used for decades, and I've looked at many others as well. And some may be helpful, but it can become overwhelming looking at all of that. So I've zeroed it down to these two. And it looks at breadth. What's the participation of thousands of stocks in the market? And while the concept of overbought as it relates to an oscillator is irrelevant, as it relates to the broader markets, it's important. But all by itself, it's not a reason to act. Meaning, what I have found is that the important points in time are when breadth and sentiment are in agreement. So what we're looking for is when the broader markets have reached an extreme move to the downside or the upside, and sentiment, which is based on the equity put-call ratio, is also at an extreme. Now, the breadth is based on what's called a McClellan oscillator. And all that is if you're looking at advancing stocks minus declining stocks, and you were to look at that squiggly line, that EKG of advancers minus decliners whipping back and forth, and then applied two moving averages, which, if you're familiar with what's called an MACD indicator, all is that doing is looking at the difference between two moving averages. And that is what this McClellan oscillator is doing. It's looking at the difference between the 19 exponential moving average and the 39 period exponential moving average of that advance minus declines. And it oscillates back and forth between the 100 to 200 area, meaning plus or minus 200. And so what we're looking for is, you can see in the green boxes, when it moves down below minus 100, in between minus 1 and 200. Sometimes it'll get down to minus 300 during an extreme move. And historically, markets will bounce pretty soon after it gets down there. But that powerful move is a warning shot across the bow, where it was a pretty powerful move. And you can see that was a powerful move to the downside. But at times, the move price-wise will not be as extreme as what you see on this example, but you'll see that McClellan oscillator move down to that low level. And while we would look for a bounce, we want to pay attention when if it goes down to that minus 300 level. The normal areas, down at minus 100 to 200 or up above plus 100 to 200 would be considered, the normal levels that it would move to. But our focus is going to be when sentiment and breadth are in agreement. So that put-call ratio, the static extremes of too many call buyers versus put buyers, call buyers being bullish bets, put buyers being bearish bets, 0.80 is the extreme where there's too many calls versus puts, and 1.2, too many puts versus calls. Now, this can move day-to-day extremes, and from a swing trading perspective, that's really not our interest. From a swing trading perspective, I'm interested in when that sentiment moves to an extreme based on a 5-period moving average of those closing levels. And what you can see here is that I put these envelopes around that moving average. So the way to create that is to put a 100 MA of the closes. You don't see it on the chart because I've just blocked it out. And then you create this envelope, a 10% envelope and a 20% envelope around that 100 MA. And it creates this envelope which will adjust your levels for bull and bear markets. And it works. I've used it for decades, and it's an excellent way to make adjustments for market environments from the static levels. Now, those static levels can still be reached in a bullish market, whereas, it may not get up or get all the way down to the 1.2 in a bullish market, but it'll reach the bands, and vice versa to the higher level in a bear market. So it helps to make adjustments for that. But our primary focus here is when they're in agreement, they give us short-term swing trading signals for either there's risk for longs in an uptrend, and when there is greater opportunities during correction in a bull market. So, market internals, in addition to what I've shared with you already, just increasingly is putting the odds in your favor, and you can see the accuracy of the turning points when they reach bullish levels or when it reaches a bearish level. You may have heard of the term of a yield curve, and it's simply looking at the difference between short-term interest rates and longer-term interest rates. I use the 30-year and the 3-month, the two furthest extremes. Some will use the 2-year and the 10-year. I've looked at both. They pretty much move together. So you're really not getting an advantage or disadvantage of one versus the other. They're going to, move, pretty much in lockstep with each other. So what we want to look for here is when there is the risk of a big bear market. And that occurs when you have inversion, where you have short-term interest rates above long-term interest rates. And this just plots this and gives us a very clear view of when that has happened. And so if it gets below 0.5, I'm saying, hey, that's something to be concerned about. Now, the lag time here is pretty long. And you can see where, and back in 2000, where it had gotten near inversion and then in inversion, it took a while before the market started to move lower. So just knowing that ahead of time is a huge advantage. Don't expect this to be pinpoint accurate to where it reaches an inversion and then you get an immediate turn in the market, because historically it just doesn't happen that way, but it's extremely accurate. And then when it gets above 3.0, that's extremely bullish, where the spread between those yields are historically very wide, and the bottom takes a while to form as well, but we've got objective information that provides us think buy here. And then we're going to wait for that price confirmation, and we're also going to rely on breadth and sentiment and everything else that you've learned here to put it all together, to be objective, because during corrections, we really don't know how low it's going to go. Right? We have the tools to determine bottoming type of price action, but bottoms are erratic by definition. They whipsaw, but as we're seeing these internals coming together, we know that the odds are increasing that the market is reaching a turning point, either bullish or bearish. Then we're looking for price confirmation. We're looking for a breadth and sentiment confirmation. We're looking for multiple time frame confirmation. And odds are we're going to get it right if we're looking at it objectively with the tools provided. So what I do every single week is I track this. And I put it in a little minder like this. I manually do it, and it's just part of the exercise that keeps me objective and monitoring what's happening as to, is there an alignment between breadth and sentiment? Is monetary bullish or is it bearish? And that's not going to change too often. But is sentiment bullish, bearish, or neutral? Is breadth bullish, bearish, or neutral? Is it turning? Are they all in agreement or in disagreement, and so on? Now, how much of this work you want to do on your own, of course, is your choice. But part of the advantage of the market advisory letter is that I'm doing the work every week, and I'm reporting on that. as to market internals, what's happening in the broader markets, and so on. The focus of the ETF ladder is just that. Its primary focus is ETFs, but I do comment on different sectors of the market in the advisory letter, whereas in the ETF letter, the recommendations are there as to we're buying this particular ETF and looking to hold on to it intermediate to long term. Where the advisory letter is focused is on swing trades in particular stocks, sometimes ETFs, and of course we're looking to trade many credit spreads based on various chart patterns as well. So my job here in this seminar is to provide you with the tools to do it on your own, and then you'll decide for yourself how much of this information you want to utilize for yourself day to day and week to week. But as mentioned, if you're utilizing the TC2000 platform as a student, I'm very happy to provide you with the scans that I use to help you do it on your own. So let's move on to the next section and continue to build on what you've been learning here.